You are listening to Mining Stock Education.
If you just kind of appreciate what this sector does once momentum gets started. I mean, look at any historic junior chart. Once momentum starts, it just feeds on itself. What's weird is that it hasn't really happened. Not even gold to 3,000 has been able to do that. And I also then think it points to how irrational this sector really is, and it's all about momentum.
Welcome to Mining Stock Education. My name is Brian Lenny. Today with me I have Erik Wetterling, who is a private investor in the sector and editor of thehedgeshorseman.com. Today you'll hear Erik's thoughts on the current gold market, his plans for the upcoming PDAC conference, and where he's deploying money into the market right now. Erik, thank you for coming on the show. Let's start with gold. The gold price is soaring. We're on the edge of $3,000 per ounce. Some share prices have responded, but I would say it's definitely not that tide that have risen all boats. What do you think? What do you think about the sector right now?
Well, I literally love this sector right now because it's the first time ever you can really be an actual value investor. China. I mean, I think it was Rick Rule that recently said that gold mining stocks are never cheap because they always price in a higher gold price to optionality. And then he ended with, except today. So it's like, I've never seen anything like it. It's almost like you scratched a lottery ticket. It's like, what is the gold price going to be at, at point X or point Y in the future? It's like, oh, $3,000. Then you would just assume, I mean, if people told me a few years back, we're going to see $3,000 gold in 2025. And if I had to guess where the miners would be trading, it would sound absolutely crazy because that would be, a stark contrast to where they're actually trading today. So I think it's a buyer's market for sure. I think there's dislocations. I mean, obviously, one of the reasons why this sector sucks is because it's been getting harder and harder to do anything permitting-wise. So, I mean, if you're looking for growth, organic growth, that's probably never been harder. And you had the inflation for a while, and you have a capital-starved junior sector at least. So, I mean, I think it's kind of reflecting the fact that the mining sector has sucked and is one of the hardest sector around. So that makes sense. And 90% of the juniors are kind of worthless at the end of the day, or have extremely low probability of actually monetizing what they have. So one should say that, most juniors should never go up. So, I mean, they shouldn't catch a, let's say, rising boat. They shouldn't care what the gold price is doing because they will never have anything that's going to monetize today's gold or what the gold price is 5 years from now. But at the same time, it also obviously makes the juniors that are advanced, that might be able to get their mines permitted, for example. I mean, they're going up in value on a relative basis because it's so, there's such a shortage of that. And I think that goes back to why we're seeing, the M&A. We saw one today, Equinox and Caliber, I think. Right. I mean, they're what? They're buying de-risked ounces. They're kind of hoarding the mines that are gonna take advantage of today's gold price. So it looks like a game of musical shares kind of. Everyone's trying to get everything that is can be monetized now or can be monetized soon. But the problem then, of course, is that what do you do when you picked up all the assets in jurisdiction you wanna be in, and there's nothing left to pick up? I mean, it's like, do you merge with another major like we've seen? That just makes the problem even worse because it gets even harder to grow. I mean, this is a long-winded answer to, I don't know if I even answered it, but I would just wrap up by saying, it's like, I really think, this is a time for due diligence. Yes, the entire sector is cheap. Yes, every trading sardine, the next big move, and we talked about this in our last interview, the crash had already happened. The next big move by default is going to be up. So you could, make money on, I guess, everything, even though that's not my cup of tea. So it's a cheap sector, but I still think it's like even good stuff, even like top 10% of cases or something like that, they're still cheap. So I don't see the you don't really require to take too much risk, I was going to say, to have like above average returns going forward, simply because the amount of margin of safety for the good projects is so extreme. Again, given where the price of gold is and how they're trading, I mean, why bet on a super long shot when you can buy like, I don't know, 300 million of sunk cost, 3 billion in MPV at like 200 million? Why even bother buying an early stage silver shitco for 20 million, hoping that, you know, on the off chance that they're going to find something, and that's going to take 40 million to prove that they have something. So you're looking at like 6 dilutions down the road, and it's not even going to be worth as much as whatever gold developer that's worth, you know, 20 times the market cap right now.
Right. Well, so, you know, I think I agree with you that it's sort of obvious what the value is in the especially in the gold market right now. So what is it? Is it tech? Is it crypto that keeps people distracted from recognizing it? Like, what's keeping people out of the market?
I would guess so. I would think so. I mean, the funny part is that the crypto, for example, and Bitcoin, I mean, it's kind of the perfect trading sardine, especially Bitcoin, or I should say it's the perfect narrative for a trading sardine, because the narrative, and I've discussed this with, you know, some Bitcoin maximalists just to get a sense, I mean, how are they thinking? And it always starts off with, you know, I'm scared of inflation. I don't want the government stealing from me, yada, yada. So you have all these rational, you know, ideas, and then you probe a bit more, and then you learn that, oh, and I also expect it to go up 50% per year for 20 years. So it's like at the end of the day, it's just, you know, typical greed. But in the sense, it makes sense, because if like this one guy I talked to, he had 98% of his wealth in Bitcoin. I mean, how do you sleep at night with that kind of position? So you kind of have to brainwash yourself that you're not actually taking risk. If I had 98% of my net worth in a shitco, and I knew it was that risky, I obviously wouldn't be able to sleep. I mean, I would be selling immediately. So I think it has the perfect Bitcoin narrative of like, it's seen as good as gold. And unlike gold, it just won't track inflation. It will actually go up like 20 to 50% per year. So it's like the first ever free lunch, in a sense, that it's supposed to be risk-free and make everyone rich. Not just, you know, keep you rich like gold would, but it will actually create wealth, unlike gold, because as we know, gold doesn't really multiply itself or anything like that. So I think that is one part, and also the fact that, I mean, look what the experts in crypto say. They say, I'm thinking like Michael Saylor, well, Bitcoin is going to go to $13 million per coin. What does the total Bitcoin newbie say? It's going to go to $13 million per coin. So, I mean, you can't really be that wrong. Whereas in the junior mining space, I mean, the amount of landmines there are, so I mean, whatever, you know, some odious deal on the project, or like management is crap, or they're stealing, or they're hiring, whatever. I mean, there's a million landmines, which, I mean, it's basically a jungle. And I can understand that it is very hard, because we also have this, well, at least last 15 years, where this sector is like 80% of the time it's in a bear market, 20% of the time it's in a ripping bull market. So you're like, the typical investor is like miserable for at least 80% of the time. And then compound that with the fact that nobody actually buys low and sells high. So, I mean, you're just getting raked across the coals. So it's like nobody wins in the typical investor doesn't win in anything, but it's like in junior miners, especially because it's such a jungle. Whereas again, compared to cryptos, like you cannot be that wrong. Dogecoin is a meme. The creator of Dogecoin said as much. So everybody knows what the rules are. This is just a trading sardine. There's not going to be, you think the product is worth X and it ends up being worth 0 or something like that. So I just think it's like, if I didn't like doing due diligence and whatever, and just treated the junior sector like trading sardines, like most people, short-term momentum investors, why not go into the crypto? I mean, it's like you can't be that wrong, because everybody's just betting on what the price tomorrow is going to be. It's not like Dogecoin is going to come out with a dust or hole and it's like, oh crap, I I made a mistake. So I think it makes perfect sense. And tech, it's just, yeah, I mean, it's hot. In tech, you can grow quickly if you have a product. I mean, it can just, you know, in mining, it's like, yeah, okay, we found something. 10 years from now, we'll keep our production even because that's when our first mine ran out.
So do you think that something has to happen in crypto or tech for money to move in to resources, or is resources going to attract people just on its own?
That's a good question. I mean, I don't expect humanity to change anytime soon. So it's going to perpetually basically be momentum trading that attracts people to any one sector. Because obviously, if value was on, or, you know, value investing was on the mind of investors, we wouldn't be here in the mining space. Not with the good, I mean, good companies or with the good projects. And also, I mean, yeah, I don't know what has to happen. I just think that, again, it's like humanity is not going to change. Something is just going to make some of these units go up. And it's like, I like the saying, you can ignore reality, but you cannot ignore the effects of ignoring reality. So many juniors are ignoring the reality, which is where the gold price is today. But the reality is also that all these major miners who are making a boatload of cash right now, they need to replace the reserves. So, I mean, the market can keep ignoring how good and profitable the gold business is right now, for example. The major miners are not going to, I mean, ignore that. I mean, that's their business. They can't sit on their hands forever. So it's like today's M&A, for example, I think that's going to kick up. I think we're seeing in some parts, I mean, US, for example, now I think permitting is going to get better. As like for the first time that I can remember, I hear junior producers talking about, well, I guess we need to, you know, give out dividends. I mean, first of all, just the fact that a junior producer is making any money is like almost a, you know, a novel thing. And so much so, or the margins are that good that they're talking about, you know, dividends. So that also opens up the interesting thing with, again, how you can find some like subsectors where it's like, okay, if the market is ignoring it, cash flow or margins doesn't care what the sentiment is, right? I mean, you can have something trading for nothing, but they're actually producing gold. And let's say, I mean, in 2 years from now, some juniors like, oh, they're going to have their current market cap in this shitty sentiment environment in your free cash flow. So do you really care, you know, if sentiment doesn't change? I mean, in that case, you could maybe get 50%, you know, dividend yield on what you paid today. It's like, again, I might be straying a bit from the answer, but I would end with, I don't know exactly what will, you know, make it change, except for a price momentum to change. And then I don't know what's going to be the generator or the creator of that price momentum. Is it crypto that it starts tanking, for example? Maybe. And I mean, that's what I think at the end of the day. 99.9% of them are going to be, you know, burning car wrecks. So that's going to come someday, but it's like, is that in 5 years or 10 years? Like, I can't, I mean, it's interesting to know. And if I would know when it would change, I would be, you know, that would be great. But it's like, since it's unknowable in a sense, and I don't know exactly what would kick it off, I can't really act on it. Just the bottom line is simply that still, even though, yes, we're up a bit, I mean, some juniors are up quite a bit from the 2024 lows, I would still say that, I mean, the big move is still up if gold doesn't crash $1,000 or something.
Right. Well, what about headlines? Like, there's a ton of narratives going on right now in the sector. One in particular that I can remember going back ever since I was looking at precious metals, I've heard the narrative surrounding the auditing of Fort Knox. And with Trump's selection, this has crept back into the mainstream golden narrative. And it's coinciding with some interesting charts I've seen from some commentators. Specifically, there's one that shows Swiss gold exports to the US. I guess it's a monthly chart or something like that. And it shows that it's like skyrocketing. And so there's a lot that's going on towards the building of these narratives and what they may or may not mean. What does something like that mean to you?
Not much really. I mean, it just makes me it's cool to see, because like my biased mind wants, I like the idea of that the Fort Knox vaults are actually empty, and it's like as soon as Trump won and Doge started, they're like, oh crap! I mean, the cupboards are empty. We have to fill them up, because otherwise, we're gonna crash the entire system or something like that. So I mean, something is obviously happening. I mean, these are remarkable import numbers. So I don't know exactly what it is. If it is tariffs, if it is, that they don't really have all the gold, or are they preparing for something else that's going to include gold? Meaning there's like, theoretically, they could have had all the gold, but they're adding even more gold. So it's like, I don't know exactly what's going on. There's something going on, and it could be one of those. It could be all of them. It could be two of them, whatever. And it's like, when I look at the gold price, obviously the gold price has good sentiment. At least it's going up, and it's at all-time highs. So I'm kind of expecting a pullback at any one day, because I can see how the chart has gone, and I know nothing goes straight up forever. And so I'm a bit, I guess, nervous in the sense, like I'm expecting a correction at any point in time. I just keep myself from actually acting on it, because I don't know that's going to happen. I don't know what's going to happen with the miners if that happens. All I know is that I think there are juniors out there, and specifically gold juniors, because gold price has done better than the silver price, that, like Pierre Lassonde said a few months ago, like their price, like gold, is at $1,700. So in my mind, I have $1,000 margin of safety. Whereas like if I bought something today and I think it's pricing in $1,700 gold or $1,800 gold, unless gold goes to 1,600 or something, I actually didn't overpay for it. Now, that doesn't mean, of course, that the share prices of these juniors can't go down 50, 60%. But if that's, again, it's like if my biggest problem is a short-term, flash crash or whatever. I mean, it's like the COVID flash crash. They went down, but they were super cheap. It lasted for 3 months. That's a luxury problem. I mean, for me, risk is overpaying for something that should go down, and more importantly, it should stay down. Again, going on a tangent here, but it's like I would say that it's very interesting, and I try to keep myself from not, because I drink my own Kool-Aid. When I see gold price go up and you read that Fort Knox may be empty, I want to believe that, But I can't allow it to actually make me change anything. It's like, am I going to go buy a different type of company? Am I going to bet on optionality plays just because of that? It's like, what if that doesn't happen? What if we have a correction? Am I going to sell low then? So any information that I can't really be pragmatic about and actually include in a strategy where you have your buy and sell conditions, I mean, they make sense as they relate to each other. Anything else other than that, that's interesting noise. So I don't really care what happens in Fort Knox. I still know that every gold mine is eating up their future,
Right. What about like we were talking, the value and the opportunity in the gold market is obvious. Does that keep you away from investing or speculating in the other metals?
No, I have an emphasis on the gold sector right now, simply because I think that is the most obvious price to value gaps. I mean, that's where they are found, because I can look at some copper projects. They might have, let's say, 3 billion MPVs and IRR, so like 24% today, and have a capex of like 1.5 billion. Whereas like you can find gold projects at face value, at spot gold, they're worth 3 billion. Capex is 600 million. The IRR is like 77% or something. So, and typically not all of them at least. I mean, some actually do price in that, the projects are good, even though they're not pricing in fair value to today's price. But I would say it's much harder to find that in other sectors. I mean, lithium, I would be interested in maybe because it's so hated. I mean, there I would be contrarian. But then again, I don't know anything about lithium really. People say it's, like chemical companies. I don't even know where to start. I don't know what are red flags. I don't know, what are not red flags, I was going to say. So it's just without outside my circle of competence. Copper, I understand better. And that's more, I would say, from the need, like to have some diversification. Because longer term, copper is like, okay, consensus is that it's going to be, required. And we're seeing that, in the real world, since we, are consuming more copper every year. So that, I think, is one for the future. And they are also really cheap. It's just that, there's not too many copper products, I would say, where it's like, like gold produce where, the, payback period is 1 or 2 years. No, there's no like super duper charge copper products that I know. But again, given that they're not pricing in that either. So, there's huge deposits selling for like 200 million. And if copper goes to, $6 or something, and this supply shortage actually manifests, who knows what that's going to be selling for? So I'm open to everything, but it's just the less I know about the actual commodity and how you would, mine it, or it's like the economics, I tend to stick to people, third-party validation. If you have Rio Tinto into something, you don't need to be an expert to figure out that Rio Tinto probably has an idea what a good product is. So I dabble a bit here and there. It's just that it happens to be that gold is where I think the biggest margin of safety is, and the other ones are more like you're betting on something good happening with the metal prices.
A while ago, I had a conversation with a mentor, and he definitely didn't mean to, but he mentioned how he was trying to consume as much information on a certain subject as possible. And I thought that really stood out to me because I've always kind of gone back and forth in terms of how much I let myself consume, because you can kind of get wrapped up in the noise. What about you? When it comes to consuming information, macro, micro, how do you filter?
That's an extremely interesting topic. One point of that is like when you're a person who uses Twitter or whatever, or any forum really, 95% of the exposure from the comments and whatever is going to be what people think is important or what they find interesting, for example. If you look at Twitter, most of the topics or a lot of, I guess, let's say shows, whatever, it's a lot of focus on what the commodity is going to do, where the next move is going to be. And if I look at Twitter, it's, people are guessing short-term price of gold and silver and metals and short-term price of stocks. That's basically it. And of course, since everybody's guessing that, everybody else thinks, well, okay, of course, everybody's trying to guess that because that's what's important. So I try to keep myself from consuming too much that will, stray me from, or, get me to stray from the path of like simple, dumb value investing, long timelines. Because I get FOMO as well if I see some stock running, or like somebody says that is going to go higher, or that is going to go lower, or whatever. So I actually do go back to the basics of like I like watching like Monish Pabrai, who's a mentor or a mentee, I guess, of Warren Buffett and Charlie Munger. I do like to listen to those people, and I see all the time people make fun of people quoting Buffett if they're in the junior mining space. I have no problem with that, because like there's concepts etc. that still are true. Margin of safety and so it's like, just because it's not a Buffett type sector doesn't mean that you can't have any idea of what intrinsic value might be, or how that you're actually I'm buying a company, I'm not buying a stock ticket, for example. Just concepts like that. And then I like to listen to or typically the ones that I know have, whatever, let's say they made a lot of money, or they're real experts in the sector, like Ross Beatty. Rick Rule, I think he's the master of common sense. It's like, and he's very good at, communicating it. It's like everything he says basically makes sense. There's only like 1% of the stuff he says that I don't necessarily agree with. But other than that, it's like I want to listen to the ones that we know have done it. and know how to navigate. And with that said, of course, you have to make some adjustments. For example, that I know there's people who, again, are short-term traders and they look at the liquid unions and whatever. I mean, you can never really scale such a strategy. So I would say is that listen to people who have the same kind of mentality and strategy that fits your psyche, because I'm not a trader. So I don't listen to any trading shows really. It's like, I don't care if somebody says that there's a golden cross in gold and that means whatever. Everything that can get me away from just sticking to the same strategy day in and day out, in and year out, I kind of try to stay away from. I mean, I have no idea what the Fed funds rate is right now. Absolutely no idea. I don't really care about anything macro. I don't listen to much macro because there's a risk that it will influence me. If I get influenced, it's like I bought something, then I listen to some negative macro guy, and he makes me to sell. I mean, then I bought from a value investor's perspective, and then I sold as a trader thinking that, it's going to go down soon. So it's like, that's not a strategy. You're just flipping around strategies. So I it's always a long rant, but I try to consume a lot. And I like to brainwash myself. Yes, I mean, if I watch some Warren Buffett clips that I've seen 5 times, it makes me more patient, at least in the now. It's like, it just reinforces the idea of what realistic returns are, because everybody out there is chasing 100% per month. And that's why they can't make any money ever. Whereas like Buffett and those guys, I mean, they're like, from a long-term perspective, this is a, solid bet or whatever. So, again, I don't know how well I answered your question.
Oh, it's very good. It's very wise. I completely agree with what you said. Further with the consumption of information, you're going to be going to PDAC next week. Why PDAC, and what do you get from these sort of conferences, or how do you plan your trip out to make it worth your while?
I guess I'm a bit lazy when it comes to conferences. I would say it's like a lot of the time in one-on-one meetings. I mean, first of all, I typically think I should have a pretty good idea if a company is interesting. I mean, I don't think, almost never have I taken a meeting where it's like, I looked at a presentation, didn't see anything to be excited about, and then take the meeting anyway, waiting, to get my brain blown. I would maybe do that if, you had some, well-renowned, if the Landins were in something and, I didn't understand it, then I would, want to set up a meeting because I could buy that stock blindfolded and I would still probably outperform everyone. That's the beauty of like third-party validation and the fact that they are the best investors in this space. But PDAC, for example, you just know everybody's going to be there. And it's always good to, I have an idea what, companies I already like. So I don't think I'm going to be meeting too many new ones, because that's also I need a filter in a sense that anybody that pitches me a stock now, if it's decent, it looks cheap. So that makes it very hard to keep yourself focused because you're going on impulse all the time. Somebody pitches you something, it's fresh in your mind, you just read the presentation, and then you're like, oh, this is cheap. So you put in a bid, for example. Then you come back to a story you looked at like, 6, 7 stories ago. And it's like, well, this was actually cheap. It's just that I had forgotten why, this was so good, because I got pitched something new and exciting, or whatever. So, and that can make me, then you're kind of unfocused in a sense. So I actually don't almost want to hear too many new stories. Because it's a luxury problem, but it's like my brain is going overdrive. Sometimes I have problem sleeping because I'm like comparing 20 cases, running through them in my head. It's like, okay, which is actually best? Everyone is cheap, but it's like, what is the cheapest of the cheapest? But the good thing with conferences, especially, is that, I like to quote, I think it was Erik Sprott who said that, he doesn't like necessarily analyst reports where they're conservative and stuff like that. And he's like, I'm an investor. I want to hear, I don't want to hear your conservative estimate. I want to hear, what do you think it's going to be? And that obviously in many presentations, they are very, they have a one full page of, forward-looking statements, yada, yada, yada. But if you have like competent guys, let's say, you think they're competent at least, and in one-on-one meetings or you meet them at the pub or whatever, it's like, I want to hear their forward-looking statements. Because as Erik Sprott says, it's like, see the future early. It's like, that's how we make money, right? I mean, you take something that's priced at X today, fast forward 3 years, what's the value in 3 years? I don't want to hear just what you exactly can say you have now. And forward-looking statements, I can't say anything. So one-on-one meeting and conferences, I mean, they open up a bit more. And you can obviously do more follow-up questions. But the important thing, I guess, is like to be prepared beforehand. Already have, the questions you have in mind. That's not always the case if it's a new company. But I would say I really do think I underestimate how good and important conferences are when you can, get some flow in the conversation. Then, of course, it's always like a day later when you thought about the case, you forgot to ask, 3 questions or 4 questions. Then you can, of course, also call them up later. I don't think it's a requirement, conferences, but I do think that if you actually make use of it, I mean, there's a lot of stuff that doesn't show up in the presentation. I'm not saying insider information, just like if you put the gun to my head or to his head, tell me what can you see going on here? How could this play out?
How about, you definitely talked about and covered well the company side of things, but what about the network effect? I think for me, it's changed so much over the course of my investing career where I almost value the networking, like seeing you each year at PDAC, more than I do the stories and the companies. How can a general retail investor, go to a conference like PDAC and expand their network? Do you have any suggestions?
That's a good point, and I would absolutely 100% agree with you. I mean, it's the people side of things, just meeting everyone, and sharing some ideas and stuff like that. Because let's face it, everybody's busy today. There, you have a very good reason to just talk mining stocks, for example. Everybody shares their interests. I mean, tips. I would say it's probably hard. I don't know. I mean, I'm kind of an outsider. To begin with. I mean, I don't live in Vancouver, for example. I mean, when I started, I didn't know anyone in Sweden who even owned a mining stock, basically. So it's like, and that's also, I think, has influenced me in the way that, I mean, if you live in Vancouver, for example, if you're an insider, it's like, everyone. Then that's going to become a big tool, right? Because you're going to hear every rumor and everyone. But if you're an outsider, you're kind of forced to make do with presentations. Maybe you can't even get a CEO on the line or whatever. And then you actually have to go to conferences and try to, talk to them there, because they obviously don't know if they have a booth. They don't know if you're dirt poor or have some money or it's like a big shot, for example, which is, good. Unless you maybe dress like you're dirt poor and have like a hole in your shoes, that might not make them open up. But other than that, I don't really actually know. I mean, how would be the best way to bring up the network, for example. I mean, just getting to meet some of the companies you like. I mean, some of the junior CEOs and stuff. I mean, they're kind of rock stars. I mean, they're not. They're not like random people. So just to get some conversation going, whatever. I mean, I think that's a good start. And then I don't know if there's maybe some events where, you meet other investors, for example. Yeah, I don't know. I don't think I have any really good tip of how to be a professional networker, because I think I'm quite bad at that myself.
What about ideas in the sector? What are a couple of your best ideas?
Good question. And I was going to preface by saying there's a lot of stuff that I think are absolutely dirt cheap, like no-brainer bets. But again, it's like when we're talking risk and illiquidity or liquidity, whatever, they're ones that I'm not, because what everybody hears who doesn't know this sector, when somebody asks you, it's like, what's your favorite buy or whatever? What they're hearing is what is 100% sure going to go up the most in the next 6 months. So I'm very uncomfortable. It's like somebody, especially if they ask, what should I buy? Because I have no idea. But I would say that the two stores I like more than most, let's say, some of the cheaper within the cheap. One is still, I think I talked about this last time, First Nordic Metals. And I'm biased more because it's in Sweden. And one interesting thing there is that Sweden is going remarkably pro-mining. I talked to a guy he's an Australian, he's been in the Swedish mining sector for 30 years, or it's like back and forth between Australia. He has never seen, and he's worked for majors, he's never seen Sweden go this pro-mining. And so for the first time ever, I actually think I have an edge because I can read Swedish news. That's the first time ever. So that's one I like, but it's not just because it's Sweden. It's because I think their Barsele deposit, which they have 45% interest in, and Agnico Eagle has 55%. I think it's too big or too small for Agnico today. They're at 70 billion. It's not a tier 1 deposit. It's not a Agnico Eagle type, Canadian Malartic. I think it's a solid tier 2 deposit with free optionality of becoming even better. They own 45% of that. At today's gold price, they're not pricing in 45% of the Barsele deposit, I don't think. And then when they merge with, First Nordic is a merger between Goldline and Barsele Minerals. So they have 100-kilometer strike. I think they're up to 7, 8 multi-kilometer, or at least 1+ kilometer up to like 5 kilometer long soil anomaly. So the way I look at that is to quote Pierre Lassonde, you give me free optionality and I will make you a millionaire. Meaning it's like there is a lot of risk, or in the sense that there are absolutely no guarantees that they're going to hit on any one of these targets, or they're as nearly as good as they might look. But there's a chance they might hit, and there's a chance they might hit at a few of them, and there's a chance they find another Barsele, for example. If I'm not really paying for it, how much risk am I actually taking in exchange for the, exploration potential? So that's how I look at that. I just think it's a hugely asymmetrical bet. The other one, I would say Integra Resources. And it's funny. It's like I've been following Integra when they had Delamore only. I followed Millennial Precious Metals when they were drilling Wildcat, but primarily for the Red Canyon target, which is a Carlin discovery they made some years back. I don't really think I own Integra Resources. I owned Millennial for a while. And now, with the share price decline and the consolidation of now a third asset, which is the Florida Canyon mine from Argonaut, I think, the new Integra, version 3.0, with 3 assets, 1 producing mine, 2 development projects, and like a long list of exploration projects, that is, in my opinion, kind of pricing in the value of just their Florida Canyon mine, which is producing today. I saw some analyst reports, and I'm not saying they're going to be right, but it's like they had Integra trading at like an enterprise value of 0 in 2 years, because the cash they're making now would, bring the cash pile up to the current market cap. So I don't think that's going to happen because they're going to do work, but it just, shows how ridiculously cheap some of the cash flow is out there in the junior sector. So I see that also as a highly asymmetrical bet. I don't think it's particularly high risk. They're already in production. Is there a guarantee that Delamore is going to come into production? No guarantees. I think it will. Nevada North, I think same thing there. And with Trump getting in, yada, yada, yada. So I just think they're relatively low risk, but remarkably, I think they all have multi-bagger potential over the next 3 to 5 years. And usually in this space, you have to take some significant exploration risk for that to happen. That's why I have never seen anything like it in this sector.
On X, you've quoted Pierre Lassonde multiple times, and I'm paraphrasing. And you basically say that the junior sector is so predictable, it's the easiest place to make money. So my question to you is, if that's the reason, why do so many retail investors lose money?
Yeah, everybody has heard the idea, buy low, sell high. How many actually do it? It's like, is there a secret how you lose weight and get in shape? No. Everybody wants to lose weight and get in shape. Why aren't everyone in shape? everybody knows what to do. It's just that in practice, it's very hard to do because it requires a lot of discipline. What's the inverse in investing space? I mean, it's like if I go to the gym, I know I'm getting, a tiny percent stronger, let's say. In the junior space or any investing, it's like you buy cheap, next day cheaper. Okay, so the market is saying you're done. Do that for 2 years straight, let's say, where it's like, especially if you haven't picked, or let's say you're a average bad stock picker, meaning it's like you bought a bunch of shitcoins and you're down 2 years straight. That's basically, if you made a 200 buys over that period and you're down on everyone, that's a 0 for 200 in terms of looking smart. You're 100% looking dumb. So who in the right mind can think they're still doing the right decision by actually averaging down and buying that sector? I mean, it's just extremely mentally taxing to actually buy low. I mean, was a panel recently where even Pierre Lassonde, which you just quoted, he was talking, it's like, oh, I don't know what's going to happen, going to happen or have to happen for this to change, yada, yada. And then Frank Gustra was like, okay, actually, Pierre, this is what I told you, like, early 2000. And then he went on to say that Pierre had almost given up at that point. And Frank said, no, you're too invested in the sector. You have to step back and look at it and see how cheap this is and how it's going to go higher. So I think it says something how hard it actually is to buy when the sector is depressed. If even Pierre Lassonde, who said it's so easy because it always crashes and goes up, feels despondent or like depressed, and he called some of the juniors, they're in the killing fields, as he put it. I mean, yeah, that's going to make people want to buy something. Because like we're the worst ambassadors for the sector as well, because everybody's kind of, pointing out, including myself, maybe how bad, how shitty the mining sector really is, because it has so many zinc mines. But yes, in short, that's if you just kind of appreciate what this sector does once momentum gets started. I mean, look at any historic junior chart. Once momentum starts, it just feeds on itself. What's weird is that it hasn't really happened. Not even gold to 3,000 has been able to do that. And I also then think it points to how irrational this sector really is. And it's all about momentum. I mean, we had better momentum when gold hit 1,300 than when gold hit 3,000. How do you explain that if it's not like psychological factors?
Erik, where can people go to follow your work?
Well, I tweet quite a bit on Twitter, or X as it's called today. I think my username is like COMM_invest. And I post a lot of memes and stuff, anything to get myself from not trading too much. And then I have my website, thehedgelesshorseman.com. And then I post in forums now and then.
Excellent. Well, Erik, I've really enjoyed the conversation as always. I look forward to seeing you in person next week at PDAC, and hopefully we can do this again soon.
Absolutely. The same, and thanks for bringing me on, Brian.